right, John Tucker, thank you so much. We appreciate that. Alex Steele and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. As John was just reporting, S&P at 5,900. I mean, after all the ups and downs this year, pretty much year to date, we're unched on the S&P 500. It feels like a lot of effort for not a lot of payoff there. Shana Sissel joins us, President and CEO of Banríon Capital Management from Chicago. Shana, how do you put 2025 year to date into context for your clients? Because, boy, we were down 20%. Now we've retraced most of that from the recent highs. How do you position the 2025?
Well, I went into 2025 thinking it was going to be volatile, and it lived up to my expectations. So we positioned portfolios for volatility and did quite well as a result. Ultimately, what's come down to is as more and more information gets out, we have this 24-hour news cycle, and people get information in real time. The markets are able to respond to news quickly. But more importantly, we've seen that the retail advisor has been eager to jump into the market when it turns downward, which is unusual. That's not normally the case.
Yep.
It's typically the institutions, and we've seen that kind of reversed, where the institutions are holding off while the retail investors are jumping in. And ultimately, that's kept the markets from getting too far down, and they're able to rebound pretty quickly. Basically, if you look in the past, normally we look for the capitulation of the retail advisor, and we just haven't seen that. So for those reasons, that's why I think there's been such great volatility.
But on the flip side, you have to wonder then who else is left to buy the rally. So how are funds positioned? Institutional investors, clearly retail has been buying the dip. So as you mentioned, there may not be an extension of that.
Yeah, but the institutional investors have sat on the sidelines, and quite frankly, they have the bigger money to put to work and more likely to move the market when they jump back in. They're still very much on the sidelines. So I think there is some opportunity to drive the market higher. It's just not how we normally would expect it to be. It's also a little bit concerning. Obviously, the institutional investor tends to be the more informed investor. So the fact that they have stayed on the sidelines can mean a lot of things, but it's not for lack of information on their end and lack of analysis. But we talk about analysis paralysis all the time. There's a lot of uncertainty related to tariffs, related to the administration, related to monetary policy. And I think that in many ways, the institutional investor is a little paralyzed by the uncertainty and for those reasons, unwilling to jump into the market, which I think might be to their peril.
Shana, I know you do a lot of work with alternative investments when you speak to independent advisors. How are they using alternatives these days when the volatility both in the equity markets and the bond markets are pretty pronounced?
Well, that's exactly where they use alternatives. If advisors or individuals were to jump and allocate 20% of their total portfolio to alternatives, they would have actually done quite well through the volatility, as these are low to no correlation, or even in some cases negative correlation assets. And so if you look at the most volatile parts of the last 5 months, you look at March, some of April, some of February, you'll see that like a BTAL, which is the AGF anti-beta market neutral fund, that fund largely outperformed the S&P by a substantial amount, was very positive during that period of time. So even a small 5% allocation made a huge difference in client portfolios. And then you start to pair that with other low to no correlation assets like CTA and CBLS and MRSK. And then you have Bob Elliott's Unlimited Multi-Strat Fund. And you have a number of these alternative funds that all did really well through the volatility. So when equities and fixed income were down, they were up. And so that actually helped you through the volatility. So advisors that we work with that implemented those portfolios actually rode out that period of time quite well.
I know that where you look at in the tech market isn't necessarily broad strokes or, buy AI or buy the telecoms or whatever. But the Mag 7 have really helped to lead that rally over the last month. Does that continue, or do you continue to see value in different types of names?
Well, obviously, I see value in different types of names as they haven't participated and they are looking more attractive on a valuation basis. But the tailwinds really do sit with those tech companies, because the biggest tailwind to business right now is AI. And so anything related to AI, anything incorporating AI wins. And so we saw with the Mag 7, with the most recent NVIDIA earnings report, that the demand for AI is strong, and the move from learning and to the next phase of AI is there. And so the Blackwell chips, the greater need for computing power, all of those things are real and very much in their infancy, and in the sense of that there's no infrastructure there. And so there continues to be substantial tailwinds. And so that's why they continue to lead. Other areas of the market have headwinds. So if you look at, say, energy, we have increased supply coming on, but we have, declining demand from Asia. So that is great if you want oil at $40 a barrel, but not great if you're an oil investor or an energy investor. You look at healthcare, and we've seen a lot of headwinds there, but also some tremendous breakthroughs, and especially in oncology. So, there's pros and cons to everything, but some of the cyclicals are starting to look cheap, and that's definitely a place that I would be looking.
All right, Shana, really appreciate it. Always good to get your perspective. Shana Sissel is president and CEO of Banríon Capital Management.